transaction is based on the money that's there. So if money is flowing into a market, you're going to see some sort of reaction. If central banks are forcing liquidity into markets, which has clearly been the case in many examples, think of post-COVID, think of what happened after the GFC in 2008 and 2009. Markets were force-fed with liquidity, and what happened? Asset prices went up. So it's that particular dimension that's important. Now, you raise a very good point as to say, why is this perhaps more important than historically? And the reason being is this: think of the size of the financial markets relative to GDP. So in the US now, the financial markets are at least 2 times GDP, but if you go back 30, 40 years, they were a much lower percentage, maybe about 50, 60% of GDP. So the financialization of the economy, in other words, the big growth of financial markets and the importance of wealth effects, is now why this is so important in terms of what happens. I mean, you could argue the tail is wagging the dog, but nonetheless, that's the reality we live in.
In practical terms, how would investors use global liquidity, and what indicator would they actually look at?
Well, the first thing to say is that global liquidity is a concept, so it's looking at the overall flow of money in the world economy. Okay, now to actually get that data, we've got to dig pretty deeply. That's what we do. That's our business. You can do that. It's a laborious task. The data is in the public domain. There's nothing to stop people. Nobody's tried to copy what we do in the last 30 years, which suggests that it's actually quite a hard task, and there maybe is some sort of moat to doing that. But nonetheless, if you come back and look at what is practical to look at, what I would say is you look at the mechanism of how that money is moving through markets. So look for signals. You could look at what the Federal Reserve balance sheet, for example, is doing, or you could look specifically at what's happening to bank reserves in the US. You could look at similar metrics in China or in Japan, or even in the European Union. You could think about how bank reserves, bank liquidity is changing there. You could think about activity in wholesale money markets, how that's changing. For example, you could look at indicators in the US, which may be becoming more arcane, but let me try. If you look at the SOFR market, which is the overnight financing rate in the repo markets, how that reacts relative to Fed funds target. These are all important things to watch. You could look at things like the volatility of the bond markets. These are critical elements in the movement of liquidity.